Welcome, and thank you for joining us today. We have a great webinar, Controlling Workers' Compensation Costs with Performance-Based Insurance. And our guest speaker today is Bob Phelan. Before we begin, let's advance to the next slide. And we're going to tell you a little bit about your technology. Your lines are muted for the duration of the webinar. You can ask questions at any time by entering it into your question box. We will reserve a little bit of time at the end of the presentation to answer the questions, and we'll queue up as many as we have time to answer. Now with that, let me introduce our speaker. Bob Phelan is the author of 2 books, most recently, The Cost of Ignorance, What You Don't Know About Performance-Based Insurance Can Save Your Company Millions. It's a great book. I've read it myself. He's a 37-year insurance veteran. He's the CEO of the Litchfield Insurance Group. He lectures nationally on many insurance-based topics, including the one today, and has an associate in risk management. With that, Bob, the floor is yours.
Hey everybody, glad you could join us today. I'm in Connecticut, and I know we have attendees today in Connecticut and Massachusetts, and I hope you folks in Mass have the same wonderful weather that we do here in Connecticut, and you might have some interesting activities planned later today, so I'm going to get right to this. We're talking about workers' compensation. And throughout my whole career, helping middle market businesses save money on workers' compensation has been a focus point. For those of you who've been in the position of buying business insurance for a long time, you know what the challenges are. You look at your claim history and you see a lot of high reserves. All of a sudden, you get a big pop and your experience mod goes through the roof. Often find clerical errors that can run against you. Your broker comes out with a sudden rate increase, claims are denied, and this last slide I'll get into later, you probably don't realize this, but if you're a very safe company, much of your premium is being used to subsidize your competitors. Next slide, please. Why do the carriers give reasons for these rate increases that you get? Large claims that you've had, regulatory reasons, typically at the state level, medical cost inflation, adverse industry experience where the whole industry gets upside down because they've cut their prices too much. And I will say, because I know there's some Massachusetts attendees on this call, I know that the Massachusetts Attorney General has disallowed rate increases, boy, it might be 12 years now. So you don't see the same kind of rate increases that we do in other states. But what you do get in Massachusetts are experience mod factors that get higher and higher because the rates are inadequate. And if there wasn't some way for the premiums to get up, all the insurance carriers would leave the state. So as I've looked at it, it sounds like the experience mod has been the way they've recovered premium. And the problem with that is one bad year, one bad claim affects your insurance premium for the next 3 years, which is unfortunate, and it affects it more and more as your mod gets higher. So Massachusetts has some issues of its own, but the rest of this presentation should be state neutral. Next slide. This is probably the one thing, if you could carry away one thing from this webinar today, would be this concept of the 70-30 insurance principle. It's actually something I came up with to simplify and help business owners understand how insurance works. When you look at your own, let me give an example first. I have a client, I've actually had many clients over the years, and I've gone out, and let's say their renewal premium is $200,000. And they've looked at the losses for the year before and said, boy, our losses are only $20,000. That means the insurance company's made $180,000 off of us, and you're telling us our rates are going up. And if I didn't understand this 70-30 insurance principle, I'd probably be upset as well. What this means is that 30% in the pie chart is for overhead and expenses. Just like in your business, my business, and every business, there is overhead, admin, and expenses to run the company. You know, with an insurance company, it's the underwriters, the actuaries, the safety people, the executives, the claim adjusters, the nurse case managers. There's a lot of overhead, the buildings, the cars, the marketing. So they've got 30%. The other 70% is allocated to pay claims. And what's unfortunate, in that same example I just gave, if the guy's spending 200 grand and the fixed expense to run the insurance company is 30% of that, or 60 grand, and he's got $20,000 of losses, that's 80,000. So even in that scenario, my client would say, well, what happens to the other 20,000, 120,000? That must be insurance company profit. If they're making that much money on me, how do my rates go up? Well, this is the thing about insurance. Unless you're a very, very large company, you're not just paying for your own losses with the premium that you've put in the bank. You're also subsidizing losses of all the other people who are in that insurance company's portfolio. So if you're a contractor, you're in a portfolio with all the other contractors. And we'll see some examples of how this works later in the presentation. But if you're very safe, and in this case, 20,000 in losses against 200,000 in premium, meaning you have a 10% loss ratio, which means you're very safe. But that $120,000, that is mostly going to subsidize all the other companies in the portfolio who've got lousy loss experience. So that's the thing you want to learn from this, is if you're a good, strong, safety culture kind of company, big part of your workers' comp premium is going to subsidize the other businesses in your market. Next slide. And this is another concept there. How do you leverage that? What do you do to get ahead of that or get away from that? You start with a performance-based insurance solution, which we're going to explain in detail coming ahead. You introduce a strong safety culture, which is the second leg on the triangle here. And the third leg, injury management, a term you may or may not have heard before. That is somebody writing herd over open workers' comp claims to get your injured worker back to work as quickly as possible for as little payment and as low a reserve as you possibly can. You put those three together and you can leverage that, because that 70% can all be yours. If you had 0 losses, that 70% would all be yours in a performance-based insurance solution. Next slide. I refer to two types of insurance. I've actually made up this term too, just to keep it simple for people. Subsidy-based insurance is what you're used to. And what I mean by subsidy-based is what I've just described. You are subsidizing others. All the extra money that's left in the pot that you don't use for yourself is used to subsidize others. Believe it or not, the insurance companies, if you look at a historical trend over 50 years, they do not make any money in the insurance business. When I say the insurance business, I mean pricing accounts, paying their claims. It's what they call the underwriting profit. They don't make any money. They pay more out than they get in premium in a typical year. It varies by state, it varies by line of coverage, but if you look at it historically across all states, all lines of coverage, they don't make any money. How do they make money? All that money you put in premium, they get to invest until they pay the claims. And sometimes that can be years. And when they put up a reserve on a claim, they can take an immediate deduction to income on their own P&L. So the game of insurance, Warren Buffett is the genius at it, is you get as much premium as you possibly can and invest it. That's the subsidy-based insurance, and you're the one providing the engine for that, all the cash for that, if you're paying a high premium and have low losses. Performance-based workers' comp, what we're going to get into a little more today, is more of a pay-for-performance product. You pay the premium in, but your ultimate net premium is based on your losses. You'll get a dividend back based on a low level of losses. Next slide. So this is a little more of what we said before. I'm not going to repeat it. Traditional workers' comp plans have all kinds of negatives. I think the biggest one is subsidizing your competitors with poor claims. If I'm a clean business owner and don't have any losses and work very, very hard to have a safe work environment for their employees, if I understand what I've just described to you here in the 70-30 insurance principle, I'm going to really resent the fact that I have to pay other people's premium. That's really what it boils down to. And I would want to learn about a method where I could avoid that. Not for everybody, but that's what we're here to talk about today. Next slide. Here's just an example and I've used construction companies, not to pick on the contractors out there, but this is it right here. Somebody pays $200,000, or two companies, one has 50 in losses, one has 300. The guy with only 50 in losses isn't getting 150 back. The excess money is used to subsidize this contractor who's had 300. And you might think to yourself, well, I've had a bad year once in a while, and that happens. And there's a mechanism in performance-based insurance where you actually might pay a little bit more than what we call the guaranteed cost insurance. But what I encourage business owners to do is not look at the one exceptional year. Look at all the other years. And in our experience, my experience, every 7 or 8 years, you're going to have an unexpected pop. It's just going to happen, something that just no one anticipated, a true accident, you're going to get a pop, and it could be worth a lot of money. But the rest of the time, if you have a strong safety culture, strong injury management, and you're really controlling your costs, you're going to really make out, and it's going to more than outweigh that one bad year that you might have. Next slide. So what do you get with performance-based insurance? You get to design the plan. You're picking and choosing how it works. You control your insurance destiny. That's a term we like to use. You, right now, have insurance, and you wait every renewal to see what your broker is going to say about what happened. Did it go up? Did it go down? Did it go the same? Did I really get whacked? Did it a 25% increase? And you have absolutely no control over that. It's the whim of the market and the insurance carriers. With performance-based, you control your own destiny. To the extent that you control your claims and limit all the injuries, you benefit financially in the form of a dividend that will be paid to you for the money that you didn't use. In some forms of performance-based insurance, you're actually bound into a mini insurance company with business owners like yourselves. They're called group captives. It's a type of performance-based insurance. We put people into the largest group captive in the world. There's about 350 companies. But instead of an insurance company portfolio that's got big holes in their filter in terms of who gets in, one of these mini insurance companies has little tiny holes, because once you're into this thing, you don't want to let anybody in that's going to screw it up. So you know the companies that you're sharing risk with, and you know what their experience has been, as opposed to being blindly put into an insurance carrier portfolio. You get added risk management when you're in performance-based insurance. You keep the profits you earn. That's what I've been harping on. That's your money. And instead of Travelers or CNA or the Hartford keeping your money and giving it to the guy down the street who blew his budget, you keep it for yourself. So you get 100% of the rewards for the hard work that you do to maintain a safe work environment. Next slide. And here's an example. And what we use here on the math is, because it's variable, and I had my 70-30 insurance principle, but in this example, I believe we're using 33% as the fixed cost. So this is someone spending $400,000 a year with $100,000 in losses, and you look down below, and it's 400 less the operational costs of 133 less the losses of 100 equals $167,000 dividend. And as you look at that, that's not a spectacular year. You know, 100,000 against 400 is a 25% loss ratio. That's a good year, but it's not a spectacular year. I have clients that spend a lot more money than that and have a lot lower claims than that, because once you get into this type of program and realize the leverage you have, you're going to increase the emphasis on safety in your workplace, because you're going to see the direct financial benefit for doing it. Next slide. This is just kind of an interesting little piece of history here. Back a long time ago, Edward Lloyd had a coffee house in London, and you've probably heard of Lloyd's of London. It's kind of a mysterious sounding place that, you know, they sell insurance there, but not much else. And the ship owners, when they started to travel to the New World on boats, said to themselves, wow, we've got a lot at stake in the cargo hold of that boat. What if it goes down? And they came up with this idea of sharing risk. And all the boat owners sat in this coffee house, and somebody would then go and put up on the wall the name of their ship, the cargo, the time of departure, the destination, etc., and they'd invite other boat owners to participate in the risk. They could go write their name up there and put 10% under it, or 15 or 7%, which meant that if that ship goes down, they'd own that percentage of the risk. So they all knew who each other were, and you can imagine that if somebody was running a shaky shipping operation, no one was going to underwrite it. That's where the term underwriting came from. No one was going to write their name under that ship if they knew it wasn't run well. And in that last bullet point, do you know the names of all the people you share risk with? Of course not. Should you or could you? Yeah, you could. Not by name, but at least by number. Next slide. And as I said earlier, the carriers have large expenses. They're big insurance companies, and cash flow is their game. They are actually trying to make a little bit more money in the underwriting game over the last few years because, as we all know, stock returns and particularly interest on bonds has been very low. Typical insurance company portfolio is comprised of about 70% in bonds. It's important for them to be liquid and conservative to maintain favorable rating with the regulatory folks. So they haven't been making much money on the float, and they've been attempting as best they can to make an underwriting profit. However, as recently as 3 years ago, the nationwide ratio in workers' compensation was 120%. And what I mean by that, for every dollar that the insurance industry took in, they paid out $1.20 in expenses and claims. But what does that mean to you? It means your rates are going up. It means you have no control over that. It means that they got into a price war, prices got too low, medical cost inflation took off too fast, they got caught flat-footed, and they've got to pass that on and right the boat. And that's exactly what we've had happen. Here in Connecticut, anyway, we've had 3 years of double-digit rate increases to get the pot right. Next slide, please. So, not to beat a dead horse, you get into one of these programs, you don't subsidize your unsafe competitors. We've been doing this, so I've been doing this literally my entire career for 35 years, and many companies routinely save 25 to 35%. I've had clients with no claims in a year spending $500,000, and they save over $300,000 a year. So it is real. I don't want you to think as you see 50% plus that that's some unreasonable amount. We do have clients that really get all over safety and can earn that kind of dividend. Next slide, please. This compares these two kinds of programs, the subsidy-based and the performance-based. And there's one item on here that I haven't mentioned yet. I think the others we've covered in slides. And that's the bottom one, where if you're fully insured, you go out to bid. You feel like you have to keep the insurance company honest. Not always the best use of everybody's time, but if you understand all the things I've just described, you think you might be taken advantage of and you go out to bid. And that's kind of an ugly and time-consuming process. And if you could avoid it, I'm sure you would want to do that. When you get into one of these performance-based insurance programs, if you've picked the right one, there's really no incentive or motivation to go out to bid again, because now you control your destiny, as we said earlier. You determine what your premium is, not the marketplace. It's your safe operations and your injury management that ultimately determine your premium. It's all in your control. So if that's the case, if you're in a good program with the right fixed costs, you're going to stay in it. If you do switch around, it's going to be for odd reasons. Otherwise, you're just going to stick with that same program for a long time. And we have found with our group captive clients, the ones that are in this mini insurance company, if they don't get bought out or go out of business, they've stayed in that program forever. They never leave it. Next slide, please. So this gives the pie chart, and it really shows what I'm talking about here. If you look on the right, 70 cents on the dollar is potential return for you in the form of a dividend. When it's traditional workers' comp, that's 70%. Most of it is a claim subsidy for your competitors. And I can't think of any good reason, if this option was available to you, and we'll talk about who it's available to in a moment, that you wouldn't want to take advantage of it and avoid that subsidy. But it really depends on, and I'll say this here, it depends on how safe you are. And there are companies that look at this and hear this webinar and they say, you know what, we're one of the unsafe ones. We're one of the ones that are getting subsidized because our losses haven't been that good and we haven't been paying attention to it. We've just gone out to bid, saved some money, and let the rest of it take care of itself. But if you see this and say, I want a piece of that, just because you're not PBI eligible or performance-based insurance eligible today doesn't mean you can't become it within a year or two. And I give an example of that in the book that I wrote, The Cost of Ignorance, because that's just what it does, is it compares two business owners, one who's done really well with safety and one who's done very poorly and suffered financially as a result of it. But you've got to align yourself with some advisors who can help you turn that around. You know, whether it's an insurance broker or safety consultant, somebody's got to help you turn it around so you can get your losses down to a level where this makes sense. Because you have to be able to control your losses, otherwise you can't predict what your premium is going to be. And then that would be insanity. You'd be jumping into a program that won't make sense. Next slide. So here it is. You know, to create that safety-driven culture. I think that more and more companies are tuned into this. OSHA has certainly tuned people into it, but minimum OSHA requirements aren't going to get you the kind of safety culture that where this program makes sense. And a lot of companies don't realize it, but safety has a huge impact on profits. I have a client right now that was in a performance-based program, but they weren't performing that well because they just weren't that safe. And they didn't think they could do any more. They're a large construction company, regional construction company, electrical trade, and they just didn't think they could do that much. And I convinced them to take a swing at it, and they've knocked the cover off the ball. In a 3 to 4 year period of safety turnaround with a huge emphasis, their losses are at an unbelievably low level. This is a company that, if they were in the subsidy-based insurance market, would spend over $1 million on workers' comp, and they've had several recent years where their losses are under $50,000, 5% loss ratio. So they are really doing well, and if you get this as a concept and you're not safe yet, you got to know that you're leaving a lot of money on the table if you don't have a real safe company, and take advantage of that with performance-based insurance. Next slide, please. So here's a couple of quick case studies similar to what we saw before. One's average, one's best in class. And I had, you know, these dollars really add up. I have a client, in the first 3 years they were in a performance-based insurance program, they saved so much money in the first 2 years that they literally got the third year for free. And it can work that way. Some people it might be 4 years, some people it might be 5 years, and you're not going to take that money. Nobody will give you a program where you can just say, you know, credit me the next year for these 2 good years I have. But just purely on paper and a net cost basis, it can work that way, where you can get 3 years for the price of 2. Next slide, please. So you might not have heard of performance-based insurance before. You probably haven't, because I introduced the concept in a book, The Cost of Ignorance. And the reason I came up with this term is there's lots of performance-based type insurance products that are in the marketplace. I don't know the size of your companies, whether you've seen them before. Some companies, even if they are of the size where they should have seen them, their brokers have hidden them, and that's a story for another day. But performance-based insurance is huge. If you look at every major corporation that you know of in the Fortune 500, even the Fortune 1000, all of them are using one or more types of performance-based insurance. So if you look at the largest and most sophisticated companies from a risk management standpoint on the planet, and they're using this, if they think it's a good idea, why don't you? Assuming you're eligible, and eligibility is determined by size and safety culture. But if you looked at all the business insurance premium across the United States, 50% of it, because it's mostly these larger companies that pay huge premiums, but 50% of the premium, not 50% of the businesses, have performance-based insurance. And these concepts go back, well, I've been in the business 37 years, and I started using them right from the get-go. But I didn't invent them, and they were there long before I showed up. There's newer ones today. There's better ones today. There's ones that give you more leverage. but they've been around a long time. This is not some crazy concept that just arrived. Most insurance brokers either don't know how these work, or they get paid less money by the insurance carriers and they don't want to cut their compensation. If you haven't seen this before and you're eligible, those would be the two primary reasons for it. Next slide, please. So this is, I think, just a reiteration of what we've said. You control your destiny and you eliminate surprises. Next slide, please.
Well, thank you, Bob.
If you want to learn more about this, you can get the...
Oh, I'm sorry, Bob. Yes, exactly. We're going to go into our Q&A session, and Bob was about to tell you that if you want additional information, there's been many requests for the PowerPoint slides, for example. You can respond to your invitation email. You can go to Litchfield Insurance, to the website, litchfieldins.com. You can call Bob, 860-761-7201. It's a direct line, and Bob, in 10 or 15 minutes, can help you determine if you're a good candidate for performance-based insurance with all the compelling things that were discussed today. Now, we do have several questions that came in. We have time for a few of them. The first one, why do companies typically buy this type of insurance?
Well, I think that if they heard this webinar, or if they heard me, they're certainly going to get upset that they're subsidizing others if they're a safe company. So, that's going to trigger some motivation right from the get-go. The other is that they now control their insurance destiny, their insurance premium. Instead of being surprised, they learn that they can control that themselves through the behavior of the employees of the company and staying injury-free. And lastly, I mean, if you look at this and you look at your own loss levels and they're good, and you can do an easy calculation on how much you could save. And saving money is a big incentive for most businesses today. So that's probably the overriding factor.
Very good. The next question is several similar to this, which is how large or how many employees or how much do we need to spend to qualify for this type of plan?
There are a number of different performance-based insurance programs, as I said just a couple minutes ago. Some of them are really designed for larger companies, and I don't know if we have any this large on the line today, but that would be $500,000 to $750,000 for a certain group of performance-based programs. There's another group, and that's this concept I mentioned of a group captive, where you actually join an established mini insurance company. And it depends on the type of industry you're in. We have one program you can get in at $100,000. We have a program for general contractors, and the threshold there is $150,000. I do want to make one qualification, though, in giving these numbers. We've positioned this webinar today around workers' compensation. Typically, these performance-based insurance programs are more than workers' compensation. You can just buy workers' compensation, but they really make more sense when you add in auto liability and general liability. Typically, those are lines of coverage that are cleaner from a loss standpoint. So you're throwing more money in the pot that's clean relative to workers' comp. So when I give these threshold values, that is for those three lines of coverage. So I'll repeat them again. The low end of all the types of programs is $100,000. General contractors I'm isolating because they have to go into a program just by themselves, and I know we have general contractors on the line here today. And that number is $150,000, but it's workers' comp, general liability, and auto. And if you say to yourself, oh, geez, I'm right there at 140 and I'm not quite over the threshold, oftentimes if you're close, we can get it over the bar. Another question, Alan?
Yes, and we have time for this last question. There's been a few of them talking about what happens if and when you incur like a large unexpected claim.
And that's probably one topic that I've only alluded to here. No such thing as a free lunch. You can't get free insurance on the plus side and not have a negative on the upside. But here's why it's really important. Everybody that pays business insurance premiums gets a full deduction against their income for the premiums paid. The IRS has made a lot of rulings on insurance over the years. They've never defined insurance, however. But based on their rulings, here's what's implied. There's two things that you really have to have for a mechanism like performance-based insurance to be called insurance and allow you to take a tax deduction, which is obviously mandatory. You have to have risk distribution, and you have to have risk transfer. So what does that mean? The risk transfer piece is easy. If you pay a premium to an insurance company, whether it's a mini or the Travelers, you've transferred your risk to the insurance company. Risk distribution is different. When you go into that portfolio and subsidize that portfolio with the Travelers or all those other companies that are in there, that's risk distribution. The risks of loss of everyone in that portfolio is being shared by everyone else in the portfolio. So how do you do it with one of these performance-based programs? Well, you've got the same thing with a limitation or two. You know who they are. You know they're clean, which is very different from when you go to the insurance companies. And there's a limitation on the upside, but there has to be some upside. If you paid a premium and always paid all your losses out of your own pot of money, there's no risk distribution. You're fully self-insured, and if you're fully self-insured, you get no tax deduction as far as the IRS is concerned. So there's a layer above your own money where you have to share risk with others. And depending on the type of performance-based program, there's some complexity to how that's determined. And I think that what's important for whoever asked this question to know today is there is a limitation. And typically, if you have a really bad pop, $500,000, and you've only got $100,000 in your own pot of money, you're not going to have to cut a check for $500,000. You're going to have to cut a check based on a formula, and you're going to get to pay that out over a period of time. You're still going to end up way, way ahead of the game. But these are real insurance companies we're talking about here. They have to be treated like real insurance companies and play by the rules. And they have to satisfy the scrutiny of the regulatory organizations, the insurance departments of every state they operate in. So it's, I'm trying to show here today the general concepts and how they work. We'll have another webinar on another day that will get into the nitty-gritty details of the mechanics of it.
And that's a great place to segue, Bob. No, thank you very much. That's a terrific place to segue. These are monthly webinars on very important business and insurance-related topics, often performance-based insurance-related. We encourage you to check your email for these monthly webinars. We thank Bob Phelan at Litchfield Insurance and the author of The Cost of Ignorance for joining us today. And we thank you for all your time. This web seminar is now ending. We hope you all have a great day.